Welcome to the Money GPS. You came here for the truth, so let me unveil that for you. You're probably wondering what's going to happen in the coming months for the economy, and I'm going to get into that today. We'll connect it in with the stock market. I've got a lot of details about gasoline and commodities and real estate and so many other things, so stick with me. Let's begin by taking a look at Michael Burry. This supply glut at retail is the bullwhip effect. Google it. Worth understanding for your investing endeavors. Deflationary pulses from this. Disinflation in CPI later this year. Fed reverses itself on rates and QT cycles. And that's the big one. Cycles, something that I talk about all the time. This is a cycle, but most people can't see past that. They can't understand the depths of all of this. And that's real key, because if they did, they would be much further ahead. Now, there's something else there at the bottom. Just keep your returns. Stores weigh paying you not to bring back the merchandise. Think about that. When have you ever heard of this before? Now, for Amazon sellers, you might be used to this already. However, not for retail. They're not just going to give you a return if you don't bring the item back. Okay, so that's important. Two things there. And another is that we need to look at what's happening. Here you go. Fed hiking cycles with deleveraging events. Every single time there is an increase in interest rates, you see a crisis that follows. But it's not so precise that you can just say, well, when it gets to, this particular number, and then it breaks through, and then that is immediately going to have an impact on that asset. No, it doesn't work like that, okay? But we can make educated guesses. For instance, if real estate prices were too high and mortgage rates suddenly were 20%, well, then it's going to impact the real estate sector. But, by what percentage and so on, these things we cannot predict. But we have a good idea as to what's happening today. Balance sheet normalization, not nominal rate, being the Fed funds rate, caused inflation. Now, I don't necessarily agree with that. But what it does tell us, essentially, I'll translate that for anybody who's wondering what the heck this guy just said. This purple line right here, this is the Fed funds rate. That's the main interest rate. And then you've got CPI, which is the blue line, straight up, as you know, and the Fed balance sheet. So the Federal Reserve went out there and they bought all this garbage. They bought the treasuries, they bought the mortgage-backed securities, and a whole bunch of other things. They expanded their balance sheet tremendously. Now that does have an impact, certainly. They were buying literally trillions. But what it does, I believe, the way I look at, is that it basically sends a signal to the markets. Go ahead. It's like opening the floodgates. Hey, let's make it happen. But now they change that. Now they turn the tap off. And so what impact does that have? I want to get into that today. I want to make you think of some things. This is something that I found it unusual. I'll mention that in a second here. University of Michigan Consumer Sentiment Index, GDP, and recessions. And essentially showing us, by the way, it is highlighting a negative GDP right now, which I'm not sure how they got that. Okay, but regardless, it might be, some sort of projection. But essentially what we can see throughout this time, it is very clear that we always have this. Consumer sentiment comes down and a recession comes through. A lot of times it doesn't even have to be anything, let's say, that bad. It's the perception of the consumer. What's going on? You got a supply glut. You got inflation. You've got people that are working, other people who, they were quitting every 6 months to get a raise, and now that, their resume looked kind of distorted. And then you've got people that are, dealing with employers who are dealing with the inability to find workers. I mean, there's so many levels to this. Inventory to sales ratio at other general merchandise retailers. And look at what has happened. We went from having super low inventory having extreme levels of inventory. Just like the job market, it flipped in a relatively short period of time. Okay? Then we have this. I showed it in the previous video to this one. If you haven't seen it already, I think it's interesting. I wanted to highlight it really quick. If you look at this, this is the inverse of the unemployment rate, and this is the consumer sentiment. And, absolutely, as one commenter mentioned, this could be a delayed effect. And are we going to see heightened levels of unemployment? Some say that it will just be a small amount. And the argument there is that there are so many, I don't even remember anymore, 5 or 6 million empty positions. But what has changed now is that these companies have started to lay people off. These companies have said, we are starting to close down locations and this and that. So there's certainly something very different, okay? I just want to take this time to highlight Chuck Norris. Chuck Norris is giving a thumbs up right now. Have you? Hit that thumbs up. Don't think I forgot. Hottest US housing markets now have a bigger share of price cuts. And so what goes up must come down. The bigger they are, the harder they fall. You've heard all these before. It is an extreme circumstance to see what we have just gone through, particularly since 2020. I mean, this is just recently what's happening in the stock market, but if we take it back, it looks extreme on any level. My goodness, okay? Today, or I should say, by the time you're seeing this, would be yesterday's trading session, wasn't so good, okay? Kind of a little bit weak if you look at it. And why? Why is this happening? It's because of the worries of inflation, that maybe the Fed can't really handle it. And if they do handle it really well, isn't that going to create a recession? We're still dealing with that. Now, if you look at what the fund managers are saying and big investors are saying, a lot of them have said we are going to bounce big time. S&P 500 will end up, if I look at this here, well over 4,000 currently. It's around 3,900 at the time of this recording. So they're expecting it to go much higher on this bounce. We will see. I think it remains to be seen how much you can really drive a market without that stimulus. You saw that. I mean, I showed you that a moment ago. Inflation drives Canadian consumer confidence to crisis-era lows. This is the same in Canada, the UK, Australia, New Zealand, and so on. Everywhere is feeling it, and I like to bring that up all the time. Now, can you guess a central bank that increased their interest rates into the triple digits? Well, if you were watching this channel a little while ago, I did talk about this, but they went even further. World's most aggressive central bank raises key rate to 200%. We had never seen anything like this before. 200%. Wow. Well, you got to stop inflation. And how do you do it? One of the reasons, or one of the things that you have, is increasing rates. Mortgage lenders turn desperate as soaring rates roil industry. Home lending employees are facing risk of job cuts, slumping business as one of the fastest jumps in mortgage rates start to cool the U.S. housing market. So when I look at this, it is very clear to me that having higher levels of interest rates had and will continue to have an immediate impact on the markets. And then that drags on, and that's what we're seeing right now. Mortgage rates didn't increase much. And then suddenly the market started to freak out. Going back to the consumer, when I look at this, it's something important. I know a lot of Americans, Independence Day, July 4th, this is a big one. It's a big one. People have big celebrations. People come over. They have a barbecue. Okay, for a lot of people, that's the way it is, not for everybody. Well, it's up 17% year over year. And go back just a few years, the number is crazy to see year over year how this has affected people. And it's just an example. I like to do this because it's real. For a lot of people, this is real. They can feel it, they can measure it. And you see right here what's happening. The consumer is in a position in which they've hit the ceiling. I've got more examples. I don't even think I can get to them today. But that's what's happening. As gas prices surge, stations now hold up to $175 of your money when you swipe because they see what's happening. Isn't that crazy? Millions in California to get up to $1,050 in inflation relief. If you are in California, find out about this. But I just thought it was interesting that they are going to create what I believe all of these stimulus packages are an inflationary policy and try to get that to solve inflation. I don't know. Well, anyway, look, if you're going to get some free cash, that's great, but this doesn't resolve the underlying problem. So that breaks it down there. If you're interested, you could see who gets what. You probably already heard about this. And this right here, really quickly, I need to finish off with this, and I believe the next one as well. Look at what's happening. There's this clear problem that's going on between China and the US, okay? We see that. This was interesting. G7 leaders, they will formally launch the Partnership for Global Infrastructure, PG2, to mobilize hundreds of billions of dollars to deliver quality, sustainable infrastructure that makes a difference in people's lives around the world, strengthens and diversifies our supply chains, and creates new opportunities for American workers and businesses, and advances our national security. So the G7 getting together, what is this for? To do away with China. They're saying, China, you're doing away with us, we're doing away with you. Of course they can't, but that's the intention. And then this, BIS, the Bank for International Settlements, you know, the bank of central banks, they announced renminbi liquidity arrangement. This is really interesting, okay? I don't have time to get into it all. I didn't want to really bring it into this video, but I think you should know about it. So thank you for being here. So they announced a renminbi liquidity arrangement that has been developed with the People's Bank of China to provide liquidity to central banks through a new reserve pooling scheme. What is different about this is that it's not using, imagine this liquidity normally in most cases being US dollars. In this case, it's not. It's the Chinese currency. So now when other central banks want to borrow, they can borrow using the Chinese currency. And who would want to do that? A country dealing with China. And who's dealing with China? Everybody. So this really opens up some new doors. And they've been doing this a lot. The AIIB, there's, you know, they have the whole Belt and Road, which was the reference from the previous article. They're doing a lot, both infrastructure, financially, and you know, geopolitically, some crazy stuff going on. And we see that. We see that picking up everywhere. So I would be paying close attention to what's happening in China, that's for sure. And that was just something I wanted to make a note of here, because I'm sure we're going to be referencing it in the future. I hope this video was informative for you. Hit that thumbs up. You know that Chuck Norris would do the same. So I want to thank you for being here. I'll see you on the next one. Take care.